Good morning, everybody. This is Mike Kopesky with the ASA Group. I am the Director of Advanced Markets. Very excited to have everyone with us this morning. We're going to spend about 30 minutes speaking about long-term care solutions using life insurance and annuities. We have the ASA Group sales team with us today, and they are going to review some actual case studies and solutions that we have provided to our producers here at the ASA Group. So once again, very excited to have you with us this morning, and we're going to get started right now. Thank you. What is the issue with long-term care? Genworth has provided a kind of a cost of care calculator. We have it posted on the ASA site under calculators. I would certainly encourage all of you to check this out. I'm going to share a couple of slides with you looking at the current cost of long-term care. When we're helping someone determine how much coverage to buy, or if it's a life solution with a long-term care bucket, how much death benefit we should purchase, a lot of times we'll go to the Genworth cost of care calculator, and it'll help us understand nursing home care, assisted living care, adult day care, and home health care. And that just kind of helps us figure out how much we need to purchase. It also helps people understand how big this problem is in our country. What you're seeing in the next slide is we've used the age bar, and we've drugged this over about 10 years. And now what we're showing is when you're looking at cost of care, it's not how much do you need when you first purchase the product. It's how much do you need when you're actually most likely going to have a cost of care event. Depending on what statistics you look at, that could be somewhere around age 70 to 85 years of age. And so we added 10 years onto the cost of care, and you can see we've had some significant increases in care. Depending on how long that care will last, you might need long-term care for anywhere between 5 and even 10 years. And then if you multiply the amount you need per year times the number of years, that helps us figure out how much cash we would need to cover a long-term care event from the beginning to the end. Now, what we're going to do now is we're going to transition, and I'm going to turn it over to Bryce Skinner. And Bryce is going to talk about fully insured long-term care solutions.
Thanks, Mike. My name is Bryce, and as Mike mentioned, I'm going to talk about fully insured long-term care solutions. For our example, we're going to use an actual case that we did earlier this year. We had a 55-year-old male, and he was really healthy, received a preferred non-tobacco rating. He was concerned with the need of additional life insurance over the next 10 years to protect his income to his family while he's still working. He was also concerned with a long-term care event wiping out his retirement savings. The solution that we landed on was a 10-pay life insurance policy for $500,000 that allows access to the death benefit in the event of a long-term care need. Guaranteed universal life with AIG because they had the best price 10-pay solution out there. Our premium is $14,562 for our $500,000 death benefit. We landed on the $500,000 figure because he had $1 million of coverage in place through work, but he felt the $500,000 was needed in addition to the $1 million to cover his income and to protect his family in the event of an early death. One thing I want to note is the IRR on the death benefit. If we go down to age 80, for us to have built a $500,000 pool of money for long-term care coverage, we would have had to invest those premium dollars we paid in and gotten those returns year over year net of tax. And so if you look at 80, we're looking at 6.13%. And again, that's net of tax. So that's a pretty big deal to get that kind of guarantee. We're going to move on to the next slide. As you can see on the last page of this illustration, our client felt a guarantee to age 105 would be adequate. We're going to move on to the next page. A couple things I want to point out regarding the long-term care portion of the coverage. If you'll notice, the rider is labeled as chronic, and this used to be an issue when comparing to a true long-term care rider. However, the carriers have refiled that rider to remove the permanency requirement that was previously contained. The long-term care rider has never had a permanency requirement. However, now that the chronic has removed that requirement, there is no real difference between the two versions of the rider. Another thing that makes AIG unique is that they offer a per diem benefit payout, meaning that the IRS sets a daily limit on the amount of long-term care insurance you can receive before it becomes taxable. And in 2018, that limit is $360 per day. That number goes up every year. So 10 years from now, as you can see, you have access to $131,000 today. 10 years from now, that number is going to be bigger as the IRS increases that. In summary, we address the client's concerns of the need for life insurance while working. And then when the need for life insurance goes away, our client has a paid up $500,000 bucket of money to be used for long-term care coverage. Okay, I'm going to turn it over to Chase to talk about the linked benefit solutions.
Thanks, Bryce. Well, again, this is Chase Crawford. I'm one of the internals over here at the ASA group. And I just wanted to talk to you real quick about the linked benefit solutions that are available in the market. These have become incredibly popular over the last 5-10 years just due to what we've seen on the traditional long-term care market with premiums increasing or companies getting out of the business or just going out of business entirely. So these options and these products have become kind of the go-to for long-term care. The product that we discuss a lot and has had a lot of interest is Lincoln Money Guard. Lincoln National has actually offered this product for about 25 years. Been around since the early 90s, if you can believe that. But over the last 5-10 years, it's just seen astronomical growth because it packages a lot of really favorable options together in one product. It kind of the way it works is you either take a single premium payment or you can pay it over 10 years. It goes into this product and it provides the client leverage for long-term care. It also gives them 80% liquidity at all times. So if they were to ever surrender the policy, they would get their money back, 80%, no questions asked. And it's also got a small death benefit associated with it because it is on a life insurance chassis. Again, it's got everything about it's guaranteed. There's no premium increases, rate hikes, anything like that. It's a completely transparent solution. And another really big feature about it is the simplified underwriting. Clients love that. There's no medical exams, no medical records. It's just a 30-minute phone interview. It's 100% pass or fail. You either get it or you don't. No questions asked. There's no gray area. Everything is black and white about it. Another thing that our producers really enjoy about Lincoln Money Guard is the commission structure. So whether the client pays in a lump sum premium in 1 year or they pay it out over 10 years, the commissions are based off of that total premium amount. So it's just nice. All premiums or all commissions are paid to the advisor in year one. There's not trail or anything like that. So it's just a nice for the client, nice for the producer. And kind of what I want to direct your attention to, go into the next page. Right, now, as you can see here on this sample Lincoln Money Guard illustration that we put together, this client, we have a 52-year-old male, and he's putting in $11,232 a year over a 10-year period. So all told, he's put in a little bit over $111,000 into the policy. Again, Everything about it is guaranteed. Everything about it is paid up once you get to that 10-year portion. And if I could direct your attention down to year 31, when he's 82 years old, his pool of money for long-term care has grown to over $715,000. Again, it's compounding at 3% annually, guaranteed. So at that age, which is statistically speaking likely when he would need care, he is almost 7 times, increases his potential pool of money by 7-fold. It's just a pretty powerful story to be able to show someone, put this in front of them and say, hey, you can put in either as a lump sum again, you can put it in over 5 years, put it in over 3 years, but at most a 10-year funding window. And then when you need this care, when you're in your mid to late 80s, you're going to have a huge pool of money to pull from. Now, kind of a little bit of side note I want to mention about Lincoln MoneyGuard is the benefits are paid on a reimbursement basis, which just means that care for this policy has to come from a licensed professional. The individual cannot receive care from a family member. They can receive care in their home, but it has to be from a professional nurse because Lincoln is reimbursing the cost of care. So they can't reimburse the client's brother or their sister or their spouse. So that's just kind of a key feature about it. There's also new to the market is a product from Nationwide called Care Matters, which looks and smells and feels exactly like MoneyGuard, except that it is indemnity based. So if you have a client that really wants to receive care in their home, the Nationwide product is great because it just allows them to care. You don't get the same amount of leverage you do with Lincoln MoneyGuard. So putting in $111,000 on the Nationwide, you may get $500,000 for as a pool of money when you're 82. But again, it just allows a lot more flexibility because of that in full care. If you have someone that is in that position and does not want to leave their home, so those are kind of the two big asset-based products on the market right now. And I'm going to kind of throw it over to Danielle Burns, who's another one of our internals over here, to talk about the life insurance review process and kind of prospecting long-term care opportunities that way.
Thank you, Chase. This is Danielle. I am one of the internal wholesalers here, and I also manage the life insurance review department. Today I'm going to be talking about repurposing life insurance through policy reviews. And if you don't know what our policy review program is, it is a complimentary service that we offer to our advisors to help, review in-force coverage, build and maintain those important relationships with your client. If you have any questions, please feel free to get in touch with me. So we're talking about repurposing life insurance through policy reviews. And today in our example, we have a 70-year-old female in preferred health. Concern is there's no long-term care coverage, and she's paying a premium on existing life insurance with no guarantees or LTC benefit. And the solution we're going to be showing is a Nationwide GUL with 2% cash indemnity LTC rider. Cash indemnity means that the benefit is going to be paid to the client. You don't have to offer receipts or anything to the carrier. As soon as you go on claim, that benefit is going to be paid out to you. And the benefit to the client with this solution is the ability to secure a similar death benefit and a fully guaranteed 2% long-term care benefit, premium guaranteed to age 100, and the peace of mind knowing that the policy will not lapse due to interest rate fluctuations or cost of insurance increases. Okay, on our first slide here, we have the in-force ledger from our 70-year-old female's in-force coverage. And we can see she has a $300,000 death benefit, an annual premium of $4,988, and a total accumulated value of $69,074. And here we can see on page 2 of the ledger, on the guaranteed side, paying the $4,988 annually. This coverage is going to go to age 84, lapsing age 85. And on the current side, we can see that the $300,000 death benefit is going to go to age 100. And this is the solution that we're going to be proposing for our 70-year-old female. It's Nationwide's no lapse GUL with a long-term care rider. You can see here we have the 70-year-old female preferred non-tobacco rolling over the full accumulated value of $69,074, paying that same annual premium of $4,988. On a guaranteed basis, that's going to generate $302,880. Okay, and here we can see on page 2 of the solution, paying that same annual premium that she's already paying just now. The death benefit will be guaranteed now to age 100, and she'll also have a pool of money equaling the death benefit again to age 100. So you're alleviating all the concerns that the client came to you with the guarantee to 100, and she now has a pool of money for a long-term care benefit. Now I'm going to turn things over to David to talk to you about Annuity Solutions.
Thanks, Danielle. Good morning, everybody. Yeah, we're going to switch it off at this point to the annuity side of long-term care planning. Once again, David Smith here, and all I do is annuities, and I really like the product that we've been using the last 18 months. And when I think about long-term care with annuities, I kind of like to keep things simple. I think long-term care leverage with legacy, or for legacy. And the thing about long-term care is if one of your clients is going to need it, or if you got a husband and wife and they both need long-term care, the fact of the matter is those bills have to be paid by somebody. And either your client's going to pay for those long-term care bills out of their pocket, and insurance company is going to pay for those bills with premium that's been given to them, or the government is going to pay for it through probably Medicaid and just a little bit of Medicare. But most of the clients we service out there are not going to be eligible for Medicaid, and Medicare is going to provide only a very small amount at the beginning. So let's talk about using a long-term care annuity. The carrier that I've used most frequently is Global Atlantic, and this product is actually called 4Care. But let's just look at a situation. 65-year-old widow who is in good health. She doesn't have to be in great health, just good average health. She has quite a few assets, including a $200,000 non-qualified annuity that was in her husband's name, but he has passed away and she has taken over that account. It's now hers, and it has about $50,000 of taxable gain in the contract. So this lady, she doesn't have any long-term care coverage at all. And she knows the experience because of her own family, what her parents have been through, that if you don't do the right planning, you can lose control over how you receive your long-term care services. So she wants control. She does not want a use it or lose it situation. And by that, I mean traditional long-term care policy. You pay premiums for 5 years, 10 years, 20 years. If you never use that policy and you die, those premiums just stay with the insurance company. That's why we call it use it or lose it. And she wants to avoid that, and we can do that here. And I think more importantly, this lady has a daughter and a granddaughter, and one of her main goals now is to protect the legacy that she can leave behind to both her daughter and her granddaughter. So the solution that we're looking at here is the 4Care long-term care annuity. And early on, I spoke about leveraging for legacy. And basically what's going to happen here is, since she is in good health, we've got the $200,000 in an annuity contract already. And with 4Care, you answer 10 medical questions. The first 5 are your traditional knockout questions. That's going to be, are you currently in a nursing home? Do you have Alzheimer's? Do you require a wheelchair to ambulate? All those sorts of things. So if you answer no to those, in essence, your $200,000 is going to become a $400,000 pool of money. The next 5 questions are related to maybe cancer diagnoses over the last 5 years, rheumatoid arthritis, stents, heart stents, those sorts of questions. And if you answer all 5 of those no, and then you pass the 10-minute cognitive interview, that $200,000 is going to be a $600,000 pool of money for long-term care benefits. And One of the things to point out here, very important, there's no MIB pool for underwriting. There's no medical records pulled for underwriting. There's no paramed visits or anything else. It is 10 questions, 10-minute cognitive interview. And thus far, every case we have done has gotten a triple. So the $200,000 becomes a $600,000 pool of money. This is a single premium contract, so you cut one check and you're done at that point. The use it or lose it goes away here because, as you see on the slide, there's a full death benefit of premium paid minus any withdrawals, whether it's for long-term care claims or if your client gets in a tough spot and has to start taking some penalty-free withdrawals. So the $200,000 is there as a death benefit, as a worst-case minimum for our client's daughter, and then, of course, for use with her granddaughter as well. All long-term care services are covered. The definition to go on claim, since this is Pension Protection Act eligible, you have to no longer be able to meet 2 of your 6 ADLs or have a severe cognitive impairment. And the tax-free legacy planning that I talked about at the beginning, since this is PPA eligible, all of the funds paid for long-term care are tax-free. That's federal and state. So the $50,000 of gain that was in this contract that would otherwise be taxable to the beneficiaries or to Mrs. Client will come out tax-free, as would any part of the pool of funds paid by the carrier themselves once the $200,000 is depleted. So what we're going to do now is take a quick look at an illustration. Okay, so now we've got the illustration pulled up, and this is the guaranteed assumptions for this contract. This is a fixed annuity, and at $200,000, the interest rate being offered by the carrier right now is 3%. So you'll see 3% interest rate in the first year, and then the guaranteed being 1%. However, I wouldn't expect this contract to get cut in rates too much given the environment that we're in right now, but we are looking at the guaranteed page. So you can see at the top where we've got circled, the premium that went into this contract is $200,000. We assumed our average health client answered no on all the questions and successfully passed the 10-minute cognitive interview. So if you go over to the right of the page where we have circled total long-term care benefit, you can see at the end of year 1, our client cut a $200,000 check to the insurance company, and she now has a roughly a $609,000 pool of money for long-term care. So exactly how does that work? Well, for a single life, that $609,000 is payable over 72 months. So if you take the total benefit divided by 72 months, you'll get a maximum monthly benefit of $8,455. Once again, completely tax-free when used for eligible long-term care claims. So that means this client, a year from now, 2 years from now, 5 years from now, the least amount of money she can have is $8,455 for a period of no less than 72 months. If she doesn't go on claim 3 years from now and the claims are only $5,000 a month, then the additional $3,455 stays in the pool. It's not lost because she didn't use the maximum monthly, and then just the length of the coverage would extend out. Second thing to point out here, this is for a single life, but let's assume that Mrs. Client, her husband is still alive. He's 65 as well, and they put in $200,000, and they both want coverage. Well, the long-term care benefit would still be roughly $609,000, assuming he answers no to the 10 questions and passes the 10-minute phone interview. But the maximum monthly benefit would then be payable over 90 months. So that would create a monthly benefit of $6,667. The thing about that is both clients can be on claim at the exact same time. So if Mr. and Mrs. Client, if she went on claim at age 70, he went on claim at age 71, they would both be eligible to receive the $6,667 a month until the contract pool or the benefit pool is finally depleted. But once again, the $50,000 gain has come out tax-free, and then the coverage actually provided by the carrier of the additional $409,000 has also been paid out tax-free. So let me just summarize real quick with the legacy on this. I said at the beginning that someone has to pay for the long-term care claims. So if Mrs. Client pays for them out of her own pocket, she's depleting what she can leave to her daughter and granddaughter. She proceeds with this contract and then ends up on claim. She still would have spent $200,000 that she would have left to her daughter and granddaughter. However, the insurance company would have kicked in the next $400,000, which is money that could then be passed on to her daughter and granddaughter. It's a great solution. It's pretty easy to get done. Underwriting takes, we've had them done in about 35 minutes. Very non-invasive questions, a very non-invasive 10-minute cognitive interview. So that's pretty much it for the 4Care annuity. Simple to offer to clients, simple for everyone to understand.
Thank you, David. I appreciate your comments. Very good information. This concludes our presentation, and I want to thank everybody on the ASA sales team, Bryce, Chase, Danielle, David, for being prepared and sharing these examples with you. What we would like to do now is really have a call to action. Is there a client that we can show a solution to right now? Is there someone that you've been thinking about that we could add one of these riders to if it is a fully insured solution? If it's the linked benefit, something like Lincoln, is there someone you can think about? If you've got someone with a life insurance review that potentially needs to be repurposed, or of course if someone is just sitting on an asset or maybe has an old annuity that we can repurpose for a solution like David was speaking about. You have the email addresses to all of our team, Bryce, Chase, Danielle, and David. The person at the bottom is one of our newer inside sales associates, Alex Dawson, who is also on our team. But think of someone right now, send an email to someone on our team, and let us put together a solution for you so that we can go show that within the next week. I want to thank everybody for attending, and we will look forward to doing our next webinar for you in June. Thanks so much, everyone. Bye-bye.